President Bola Ahmed Tinubu has approved the cancellation of a significant portion of debt owed by Nigerian National Petroleum Company Limited to the Federation account amounting to about $1.42 billion and 5.57 trillion naira. The approval is contained in a document by the Nigerian Upstream Petroleum Regulatory Commission (NUPRC) titled Report of October 2025 Revenue Collection, presented at the Federation Account Allocation Committee meeting held on November 18, 2025. A very warm welcome to you. This is Business Points, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. The directive clear long-standing legacy debt accumulated by the NNPCL up to December 31, 2024, effectively settling years of dispute between the National Oil Company and the Federation. Liabilities arising from 2025 operations, however, remain outstanding and are subject to ongoing monitoring. According to the NUPRC, debt earlier reported at the October 2025 FAC meeting stood at $1.48 billion and 6.33 trillion naira, covering obligation from production sharing contracts, direct sales, direct purchase, royalty adjustment, margin cost adjustment, and joint venture royalty receivables. Following the presidential directive, about $1.42 billion and 5.57 trillion naira of this obligation were formally cancelled, with all accounting entries already reflected in the Federation account. The decision followed the recommendation from the Stakeholders Alignment Committee set up to reconcile outstanding indebtedness between NNPCL and the Federation, which reviewed royalty and lifting-related liabilities up to the end of 2024. Despite this major cleanup, fresh debts are still accumulating. Statutory obligation from January to October 2025 amounted to $56.81 million and 1.02 trillion naira, mainly from PSC and joint venture royalty receivables. Revenue performance remains a concern. Royalty collection have consistently fallen short of projection. In November 2025, actual receipts stood at 605.26 billion naira, far below the target of 1.14 trillion naira, resulting in a monthly deficit of $538.92 billion. As of November 30, 2025, total approved revenue was 13.25 trillion naira, while actual collection reached 7.60 trillion naira, leaving a cumulative gap of 5.65 trillion naira. Royalty falls alone accounted for 5.63 trillion naira of this deficit. This decline is even more pronounced when compared with October 2025, when royalty collection stood at 873.10 billion naira, underscoring persistent weaknesses in revenue mobilization. The cancellation of the NNPCL legacy debt marks a major fiscal reset, eliminating nearly all historical dollar-dominated obligation and a large share of naira liabilities. It provides immediate relief of the Federation account and removes a long-standing source of contention between the oil company and the government revenue managers. However, the data highlights deeper structural challenges. New obligations are still piling up, and royalty collection continues to underperform despite improved reported earnings by NNPCL. Without tighter fiscal control, stronger transparency, and more effective monitoring of current operation, the gains from declaring legacy debt may short-lived. It could be recalled that NNPCL reported improved financial performance in October 2025, with revenue rising from 5.08 trillion naira, up from 4.27 trillion naira in September. Profit after tax also increased sharply to 447 billion naira compared with 216 billion naira in the previous month. For the full year ended 2024, the company reported a profit after tax of 5.4 trillion naira on total revenue of 45.1 trillion naira, pointing to stronger corporate performance even as public revenue remittance continue to lag expectation. The Port Harcourt Refinery Company, though officially shut down, continues to supply an average of 349,000 liters of automotive gas oil, which is diesel, daily to domestic markets, according to the latest data released by the Nigerian Midstream and Downstream Petroleum Regulatory Authority, the NMDPRA, disclosed that the refinery, which was shut by the Nigerian National Petroleum Company Limited on May 24, 2025, remains in shutdown mode with no active production. However, diesel produced before the shutdown is still being evacuated into the market, with supply continuing as of November 2025. The authority clarified that the ongoing diesel supply does not indicate operational activity at the refinery, but rather the evacuation of existing stock produced when the plant was last functional. The shutdown, initially described as a 1-month maintenance exercise, has now stretched into the 7th month with no confirmed timeline for resumption of the operation. The Port Harcourt Refinery was declared operational in November 2024 following extensive rehabilitation after years of inactive. At the time, the NNPC announced that 60,000 barrel per day facility had resumed operation at about 70% of installed capacity, with diesel and low-power fuel oil identified as the major output. The refinery was projected to produce 1.5 million liters of diesel daily, alongside petrol, kerosene, naphtha, and fuel oil, with estimates indicating that 200 petrol trucks will be supplied to Nigerian markets each day. This expectation raised hopes of reduced fuel imports and improved energy security. However, barely 6 months after the announcement of the full operation, the refinery was shut down. A similar pattern was observed at the Warri Refining and Petrochemical Company, which was declared operational in December but shut down about a month later. Upon assuming office, the current Group Chief Executive Officer of NNPCL, Bayo Ojulari, reveals that a review of the Port Harcourt refinery shows it was operating at a significant loss. According to him, the facility was losing between $300 million and $500 million monthly, processing less than 40% of the crude volume supplied to it. Based on this assessment, operations were suspended to prevent further financial losses, while options for the sustainable turnaround were explored. The prolonged shutdown has reignited debate over the future of Nigerian state-owned refineries. The Petroleum Products Retail Outlet Owners Association of Nigeria has renewed call for the privatization of the 4 government-owned refineries, urging the federal government to conclude the process transparently by the first quarter of 2026. The group argues that privatization could reduce fiscal pressure, improve efficiency, and attract private investment and technical expertise. NNPC management, however, has maintained its opposition to selling the refineries. Ojulari has reiterated that ongoing technical and commercial review are aimed at repositioning the facility as profitable revenue-generating assets capable of meeting domestic fuel demand and operating in line with global standards. The continued evacuation of the diesel from the Port Harcourt refinery, despite its shutdown, highlights both inventory management efficiency and deeper structural problems in Nigerian refining sector. While existing stock is helping to support diesel supply, the extended shutdown underscores the fragility of recent rehabilitation efforts, repeated cycle of reopening and closure, combined with heavy financial losses, raise questions about the sustainability of government-run refineries without decisive reform. Whether through privatization, concession, or credible operational restructuring, the refinery risk remaining a recurring fiscal burden rather than a solution to Nigerian energy and fuel supply challenges. The Federation Account Allocation Committee has raised concern over weak compliance by participating firm in its ongoing review of the road infrastructure tax credit scheme, as only 3 out of 7 companies contacted have responded to the request for information on their project and expenditure. This is contained in the report of the FAC post-mortem subcommittee meeting for November 2025, which examined deduction made under the scheme between February 2024 and September 2025. The review focuses on varying the scale of deduction, project execution, and the extent of private sector involvement. According to the document, the subcommittee formally requested detailed from the Federation from the Federal Ministry of Finance and Works and the Federal Inland Revenue and 7 participating companies. The firm include BUA International, Dangote Cement, NNPC Limited, Nigeria LNG, Mainstream Energy Solution, GZ Industry, and MTN Nigeria. The information sought covered the level of participation, amount invested, and project status between 2029 and 2025. FAC noted that responses have so far been received from only 3 companies, and this submission have been forwarded to the FIRS for verification. The committee stressed that the exercise remains incomplete, that conclusion cannot be drawn until the remaining companies comply. As a result, the investigation into the scheme remains ongoing. The road infrastructure tax credit scheme has played a major role in funding key projects without direct upfront government spending. However, FAC members have repeatedly expressed concern about its fiscal implication, especially as deductions are made at source from revenue meant for distribution to federal, state, and local governments. This concern intensified at the FAC meeting in August 2024, when members called for a suspension of further deduction, arguing that road construction is a statutory responsibility of the federal government. At a subsequent FAC plenary meeting in Bauchi, NNPC Limited was specifically asked to suspend additional deduction pending resolution of disputes over the scheme. State also demanded that any deduction be recalculated in line with the existing revenue allocation sharing formula with refund where necessary. In response, the chairman of the Revenue Mobilization Allocation and Fiscal Commission requested detailed record from the FIRS on tax credits granted to NNPCL and other beneficiaries under the scheme. Despite incomplete disclosures, FAC reveals that substantial deductions have already been applied between 2024 and 2025, a total of $577.6 million and 882.31 million naira was deducted from the scheme. The dollar component was deducted monthly from NNPCL joint venture gas companies' income tax between February and December 2024. Although no dollar deduction were recorded in 2025, naira deduction remained heavy, including 151.27 billion naira in February and 671.04 billion naira in April 2025. FAC cautioned that these figures do not capture the full financial impact of the scheme, as they exclude deduction granted to other agencies before 2024, suggesting that the actual revenue loss may be significantly higher. Introduced in 2029, the road Infrastructure Tax Credit Scheme allows private companies to finance approved federal roads projects and recover their investment through tax credit offsets against their company income. Tax obligations. This scheme is jointly overseen by the Ministry of Finance and Works with the FIRS responsible for implementation, while the arrangement has helped fast-track projects such as Apapa Oshodi Oworo-Shoki Ojota Expressway. It has also reduced funds flowing into the Federation account, triggering resistance from the sub-national government that depends heavily on monthly FAC allocation. Recent policy adjustments signals a shift in approach. The Minister of Works has announced a restructuring of the payment arrangement for the road project previously executed under NNPC linked to tax credit agreement. Under the new framework, contractors will be disengaged from the tripartite arrangement involving NNPCL and FIRS and instead receive payments directly from the Ministry of Works. Existing projects are to be rescoped and segmented into ensure timely completion, while the ministry itself undergoes reorganization to strengthen on-site supervision. The federal government has also approved the settlement of 263 billion naira in certified NNPC-funded road projects, subject to the existing tripartite agreement. Fact findings exposes growing transparency and accountability gap in the road infrastructure tax credit scheme. While the program has accelerated road delivery, poor disclosure by participating firms, and large opaque deduction from the Federation account from heightened fiscal tension, particularly for the state, local government facing strained revenue. The ongoing review and recent restructuring of payment arrangements suggest an attempt to regain control and clarity. However, without full compliance, clear reporting, and stricter oversight, the scheme risks undermining intergovernmental trust and deepening revenue pressure at a time when public finance are already under severe strain. The Nigerian External Reserve recorded a net increase of $4.39 billion over a one-year period, rising from $40.85 billion on December 23, 2024 to $45.24 billion on December 23, 2025. According to the data from the Central Bank of Nigeria, an analysis of the figure shows that the reserve grew by 10.75% within the period, reflecting a gradual recovery after early year pressure linked mainly to debt servicing and foreign exchange market intervention. The reserve closed 2024 at $40.87 billion, but weakened in the first quarter of 2025. In January, the balance declined to $39.72 billion, falling further to $38.41 billion in February and $38.30 billion in March, and before dropping again to $37.93 billion in April. The decline was largely driven by heavy external debt servicing obligation and transitional adjustments in the foreign exchange market. During this period, Nigeria spent about $816 million on foreign debt servicing in the first 2 months of 2025 alone, with payment of $540 million in January and $276 million in February, exerting significant pressure on reserve level. Some recovery emerged in May when the reserve rose modestly to $38.45 billion, but the gains were short-lived as the balance fell again in June to $37.21 billion. By the end of the first half of the year, Nigeria had lost about $3.67 billion in reserve, reflecting sustained debt repayment and CBN intervention to stabilize the foreign exchange market. The trend reserve in the second half of 2025. In July, the reserve climbed to $39.35 billion, crossing the $40 billion threshold in August at $41.30 billion. Growth continued through September, with reserve rising to $42.35 billion and further gains recorded in October at $43.19 billion. By November, the reserve had increased to $44.66 billion before continuing their upward movement into December, although a brief pullback in mid-December, including a decline from $45.47 billion to $45.21 billion by December 17. Some of these losses were later recovered, bringing the reserve to $45.24 billion as of December 23, 2025. Market analysts and monetary authorities have attributed the improvements largely to reform in the foreign exchange market clearance of FX backlog, improved transparency, stronger oil receipts, and renewed portfolio inflow at various points in November. The reserve reportedly reached their strongest level in about 7 years, peaking about $46 billion before moderating. However, analysts have noted that part of the accretion was supported by external borrowing, including Eurobond issuance, alongside diaspora remittance and improved balance of payments inflow. While these factors have helped stabilize reserve, concerns remain about the sustainability of the inflow amid global uncertainties and potential investors' caution ahead of the pre-election cycle. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Points, where we extract the Nigerian economy and the government policy. A quick look at the capital markets. Nigerian capital markets recorded strong activities in the commercial paper segment between April and October 2025, with companies rising over 753 billion naira through issuance. According to the Security and Exchange Commission, the regulator says the volume of issuance reflects improving liquidity, sustained investors' appetite, and renewed confidence driven by regulators' reform and broader microeconomy improvement. The commercial paper market remained one of the most active segments of the capital markets during the period, providing critical short-term funding to companies across manufacturing, agriculture, and energy and other sectors. The security explained that the performance of the commercial paper market are part of the wider capital rising activities approved during the period under review. All right, this is where we draw the curtain on Business Point today. Join me again tomorrow on Global Television, channel 365 on DSTV and 276 on Star Times. To remain connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.